Hi, I'm Kumar from Sri Lanka. I'm a professional tutor with almost 13 years of experience in CIMA online tuition experience. And here I'm making a small presentation, a video clip on our management case study for August 2020, Alpaca Hotel Group, on all important subject of financing capital projects, especially after COVID-19. So in the exam of August 2020, we are likely to be tested on post-COVID-19 scenarios. I believe this video will be a very useful one for all of you all in your study. So while wishing all of you the very best of luck, if you need any support, assistance, online tuition at very affordable rates, you can contact me on +9477 321 9387 WhatsApp, or you might contact me on Gmail, learnwithkumar5, that is digit 5, at gmail.com, or you may contact me through Facebook Messenger, Learn with Kumar, and you can see many of my videos in this YouTube channel, Learn with Kumar, and also in my profile LinkedIn. So, in August 2020, in our case study, it's a hotel company. So, let's talk about financing capital projects, which is going to be a very challenging one in the year 2020 and beyond, particularly after COVID-19. So, one of the objectives of this hotel company is to deliver excellent value to its shareholders by acquiring at least one new hotel every 3 years. So, they talk about acquiring one new hotel every 3 years. So, this company is about 90 years old. They have 50 hotels, so roughly 1.8 hotels per year had been their past. Now they say, for 1.8 years, one hotel. 1.8 years, one hotel. Now they say for every 3 years, one hotel. So probably they got consolidated, and looking at the future, this may be the way that they want to go. And in the pre-scene, it says the company has grown steadily through the acquisition of hotels as going concerns and also through the construction of hotels. So both organic growth and acquisition strategy, they have used for the growth probably in the past 9 years, and maybe in the latter part, maybe through acquisitions. So one starting point is always, whenever we are looking for funding, is the capital budget. So Alpaca should have a process to determine, evaluate potential expenditure to invest in large capital outlay. In our hotels, the large capital outlays will be for construction of new hotels, modernization, refurbishment of existing hotels, and also acquisition of any new hotels. So they are large investments over a large period of time, and that's what we say property, plant and equipment. So roughly in the 31st December 2019, there were about almost 1,987 million, if I remember right, or 2,000 million. So if it roughly divided by 50, the cost of a hotel is about 40 million. Of course, there may be certain other expenditure like head office expenditure, head office buildings, all that. But on a historical basis, it's about 40 million per hotel cost. So that's just a rough idea, which will be a very useful thing for you to know when you're working out figures, because you must get a feel of the figures as the finance manager. And as of 31st December 2019, they had almost 85 million cash resources. If you look at their statement of financial position or statement of cash flow. And as the finance manager, you must have a thorough understanding of the statement of cash flow. So of that 85 million, if you really look at, 86 million came by way of disposal of assets. So probably maybe hotels they would have disposed, some of the old furniture they would have disposed, whatever it is, they got about 86 million. And I think they invested about 56 billion in the new property, plant and equipment. So I'm not sure whether they have bought a new hotel, because maybe some kind of a cost like that. But however, they have so capital budget is very, very important. And the base for the capital budgeting is your project reports. You must get your project reports right. So the project report will cover the information about construction cost details or acquisition, cost structure, profitability, and even things like organization and management and capital structure. So you as the finance manager should liaise closely with the project proponent and prepare and evaluate these reports before we commit any funding, because it's your recommendation that will be taken by your senior finance manager, by your finance director, when making recommendations to the board. So you are providing valuable management information to the board. So remember your responsibility, and this is your one of the key tasks to evaluate and to get these project reports right. So as I said, they have been going through a strategy of acquisition and strategy of construction. If you are going for acquisitions, you need to be mindful whenever we want to acquire another company. There may be many others with competing bids. So if the project is very attractive, we need to overbid it. We need to pay something more, a kind of a premium kind of a thing. So that means more outflow. In that case, you as the finance manager should be convinced that there will be additional inflows coming up, maybe through synergies, whatever, so that you know that it justifies the project. That is what we do with the NPV analysis, to see that whether we get a positive NPV. So that should be looked at, because we will, if you are putting extra cash outflows, we need extra cash inflows to come. So as I said, this before we started January 2020, these people, because there were no COVID-19, they may have entered into construction of long-term project. Hotel construction can take more than 1 year. So they may have entered into with the contractor, some construction projects, or maybe they would have been negotiating on certain takeover bids. And now we have to look at the present situation, the time delays that could happen, and cost escalations, and also any force majeure situation. That is, the contractor may be not in a position to fulfill his task because the force majeure, because it's like an act of God kind of a situation, this COVID-19. So maybe we will need to arrange additional finances for cost escalation. So one way is to go for something like bridging finance. It's a kind of a temporary form of finance. We get it, of course, at a higher cost, till we get our main funding sorted out and approved. It takes time. So we go for sort of a temporary kind of thing, what we call bridging finance. So why I'm talking about all these things, because when you use this kind of terminology in your management case study answer script, examiner will be very happy. Because rather than just writing the textbook stuff, try to think out of box, try to think differently. So this is the purpose of my video presentations. I'm not covering up all what is in the textbook stuff, but what I'm looking at is to do something extra for you all. So from Alpaca Hotel Group's point of view, for capital expenditure, you can look for internal funding. Now, the present scenario demands we look inward, because external funding is not easy to get at this moment of time. Share markets are very dull. Banks will be, thinking twice, thrice before they give you funding. So look internally, what have we got? So I'll be discussing that in a minute. Then also we have to decide long-term, short-term. Also we need to look at fixed interest, floating interest kind of thing. very unlikely Alpaca can borrow foreign funding because their vision is more of a local vision to move to they are more in the local hotel sector. But who knows? They might be able to go because they are a listed company and get money from even foreign sources. So everything is possible. So have an open mind till you see the unseen. Now, as I said, these internal funds are very important. Remember, they have 85 million money inside in the bank account. So, roughly about historical cost basis about 2 hotels, but maybe if you add even 50% more to the historical cost, it may be about 60 million. So, there may be money, but once again, be mindful from 1st of January 2020 to August 2020, by the time you sit for the exam, 8 months have gone, and 8 months of turbulent times for a company like Alpaca Hotel. Maybe they would have been locked down and there would not have been business. So we do not know how much of those cash resources are available. So talk about those things. Don't assume that they have 85 million. Talk that during this period, many things could have happened. And non-payment of dividend. The dividend last time they paid 17 million dividend. So maybe that was based on 31st December 2018 profit. They would have paid in 31st for the end of 31st December 2019. We do not know whether they have paid any dividend in 2020. If they have not paid, very unlikely they will pay. So again, look at that possibility. But again, look at when you don't pay dividends, the reaction of the share market. So as the finance manager, you must have a very, very good feeling and knowledge about what's going to happen. And one of the important sources of funding at this moment of time is sale of your excess assets. As finance manager, look inwardly, look at all kinds of excessive assets, vehicles, buildings, whatever that you might be having, which you can sell and convert it into cash. This is a very, very important source of funding that we will have and we do have inside the companies, which we can dig in now in this COVID-19 period. And also look at the good working capital management. We should not push the suppliers, but wherever the suppliers are big people, we might be able to negotiate bigger credit terms, longer payable periods, and through that also we might be able to get some kind of funding. So good working capital management is also part of you as the finance manager. Collection of funds, receivables, minimizing inventory, all those things could be done. Coming back to external funding, there is this equity funding. As I said, stock markets are going to be very, very dull, and therefore, chances of getting a lot of money in equity funding is not easy. But maybe if you have been doing well, rights issue could be a way of looking. But our returns on equity is very, very low. I think it's about 2.7% or something, if I remember right. Very low, and that also could be a factor which might have an impact upon your funding. Debt funding is possible because this company has a gearing just about 20%. So there may be room for going for debt funding. So to do that one, you must do a good assessment of debt capacity. How much debt can company cope with? So you might not find these things in your textbooks, but these are good points, but you can put it in your case study, and the examiner will be very, very happy to know that you are writing like that. Assess how much debt can company cope with. So how do you do that assessment? You go through your statement of financial position, statement of cash flow. Statement of financial position will tell us about gearing. Now here, as far as this company is concerned, I think it was about 20.8% or something like that gearing, very low gearing. That is debt divided by debt plus equity at book values. that book values may not be truly reflect the debt capacity. In fact, their gearing may be very low because the book values, the market values are going to be very high. So again, talk about those things. The examiner is going to be very happy when you talk about those things. Say that according to book value, gearing is 20, but when you consider the market value, we don't have the details of market value. It may be much lower. So that the examiner knows that you know what you are talking about. Statement of cash flow. They are given us the statement of cash flow, so you can work out cash EBITDA. That is, from your cash flows, we can look at earnings before interest, tax, depreciation, and amortization, not from the P&L statement. The cash EBITDA, that is the cash from operations before interest and taxes, and divided by the cash interest, what they are paid in, which will give us a kind of a times cover, which will indicate how much drawn we have to pay our interest with the cash generated. So it should be a good, very interesting one. And if you look at your statement of cash flow, you will see they had about 85 million cash at the end of the year, but 86 million of that came from disposal of assets. So, they have been looking for this internal source of funding. So you as the finance manager have done a good job looking for those 86 billion of money, which is basically the end of the year money. And of course, they have invested 56 million, maybe in new hotels, maybe in modernization, whatever. Last year, they have invested 56 million of that money. And also they paid a 17 million dividend. So when we are looking at EBITDA, that is earnings before interest, tax, depreciation, and amortization, we have to look at against the volatility. The hotel industry is subject to a lot of volatility. It's somewhat cyclical, it's somewhat seasonal. And with this kind of COVID-19, they are one of the most affected industries. Also the technology. I don't think technology will have too much to do with the hotels. Entry barriers. I'm sure big companies will not want to enter the hotels at this moment of time. So you might be sort of fairly all right. So these are factors that we should look in when we are looking to work out our debt capacity. Now when you look at the capital structure, I'm talking again outside the textbook. You basically have equity, high returns. Then there's this intermediate kind of what we call mezzanine debts, the subordinate debts, and of course the traditional debt, senior debt. So in terms of returns, equity needs the high returns because of the high risk element of it. Senior debt will need a lower return because they are of a lower risk, because they probably have some fixed security, collateral, and subordinated debts are sort of somewhat in between. So what happens in a company over a period of time, with the profits, equity goes up. Equity goes up. Subordinated debt will remain almost at the same levels, and the senior debt will come down because we are repaying. That's what happens. So capital structure will get changed. Equity will go up with your profits and your retained earnings. Senior debt will come down with your repayments, and subordinated debts will almost remain at the same levels for most of the time. So I'm going to talk about some of these things in detail. Senior debt, basically it's your traditional finance, revolving credit facilities, term loans, and generally if you look at the EBITDA, you can take probably 2 or 3 times of that one as loans. So we in our company, we do have enough room for this kind of thing. So you can do a little bit of number calculation and find out, and that should be. Subordinate debt basically consists of this high yield bond. Basically, you need to pay a very high return kind of thing. And also there are these so-called mezzanine loans. They are essentially 3 types: convertible bonds, bonds with warrants, and also convertible preference shares kind of thing. So for companies, you can get all these sources of funding, and you should be able to structure your capital accordingly. So mezzanine funding, so essentially they are non-tradable debts, which is subordinated to senior debt. Senior debt has the highest ranking, highest priority in the event of repayment. Generally, these things are bullet repayments. Bullet repayments means you don't pay monthly, you don't pay quarterly, you pay one shot after 5 years or whatever. Then cash interest is paid, and also some kind of accrued return. So it comes up in form of convertible bonds kind of thing. You can convert it into shares, and once you convert it into shares, then maybe if the company is doing well, you will have a higher kind of a return. So they are generally converted into equity later. Debts with warrants. Warrants means when you hold the debt, you can get additional shares at your option. Convertible bonds means your debt can be converted into shares, and also convertible preference shares means your preference shares can be converted into equity shares. So all these funding sources are available. So again, I have moved away from the traditional textbook. You have many other things which you can discuss, commercial papers, all kinds of things. But I'm talking in addition, something which you can sort of put it in the paper and attract your examiner's attention, because they would expect us to read a lot during this time. And so I know y'all are under a lot of exam stress. So I have done some work in looking at some of the CIMA magazines, CIMA articles, all that, and I have compiled these things for y'all. Finance always should be adequate for its needs. When you need 50 million, if you are the finance manager, you get 30 million, that's not good enough. If you need 50 million, you need 50 million. It should be available at right time. When you need money on 30th of September 2020, not good enough to get it on November 2020. So you need to be very proactive and at right cost. When the cost of capital should be 8%, it should not be 10%. Finance is the lifeblood of the business. So you as the finance manager, you are the carrier of blood in this company. Of course, you plus your senior finance manager plus your finance director, they are the bloodstream of the organization. You must have that feeling always whenever we are answering a question. We will require funds for modernizations, acquisitions, and constructions. So funding will be required in all these areas. So I believe this will be of very useful, will be of very value to you when you want to write an answer. I mean, you might not get questions in the way that I have presented, but you can write many of these things in an unseen scenario. Read the unseen, read the pre-seen, and be ready. I mean, unseen, you can read it only at the exam time, but read the pre-seen well and be ready to give a good answer. So look at some of these numbers. 85 million cash in hand, 86 million they collected from the sale of assets, 56 million they invested, 1,987 million the value of assets, 50 hotels, 1930 to 2020, 90 years of hoteling and 50 hotels, and now they are thinking of every 3 years one hotel. So look at all these things and be thorough with your question. So there are other sources of funding which I have not gone. Rights issues, as I said, if your company is very good, you might, but I'm not very sure whether the company has done well from the shareholders' point of view. Bring in a return of 2.7% return on equity. Return on equity is profit after tax divided by equity capital, that is share capital plus retained earnings. You might have certain government grants coming up during this period for hotel industry. The governments are helping these companies to come back. So there may be certain facilities available. Look at those things. Supplier credit, we need to look for that one, but once again, we need to be mindful of our social responsibilities. Don't squeeze the small supplier. He must be in trouble already. Your vegetable supplier, your meat supplier must be in trouble. Try to help them. But there may be some others who are in a position to give you longer supply credit. If I import in particularly some of the hotel furnishing, you might be able to get supply credit through the bank on nuisance credit 180 days kind of facility. Leasing and sale and lease arrangements are also possible, but we need to be mindful in times of turbulence. These kind of commitments could be very, very dangerous. We saw Hertz, the big company, going for bankruptcy purely because they had lot of lease commitments to pay. So as the finance manager, you must have a very, very good thorough knowledge of all what is happening inside the world and what is happening externally, internally, all that. So this is the challenge that you have as the finance manager of Alpaca Hotel. So thank you very much and good luck for all of y'all. As I said, if you want any kind of clarification, not necessarily you need to take tuition from me, but you can just send me a WhatsApp +9477321937 and I will try to respond as much as possible. Or you can send me an email, learnwithkumar5@gmail.com. Go to my page, I'm putting up some videos, Facebook page, Learn with Kumar. Very soon I will have my website, www.learnwithkumar.com. Once again, I wish you good luck. And if there's anything, just let me know. If you need tuition at very affordable rate online, please contact me. So good luck. God bless all of you.